Hey guys, welcome to the Framework Fortune YouTube channel. If you're new, if you're extremely new to day trading, this video here is going to help you a ton, whether you're watching my videos or somebody else's day trading videos. This is going to help you quite a bit because you're going to hear us say a lot of things that you're not going to know what we're talking about just because they're foreign terms. Day trading has its own language almost. It's crazy. It's like learning Egyptian or something. Well, probably not that complicated, but still. So I'm going to go over a lot of terms in this video, basic terms, things like that. So if you're new, make sure you hit the like button and subscribe. You will learn quite a bit off of my channel if you decide to subscribe. So let's hop right into it. The market's been really hot recently, really hot. And when it's really hot, a lot of stocks get halted. And you can see today on IMRN, if you look over here, shares halted on a circuit breaker, up 94%. And then it resumed trading, and then it was paused again. That paused is the same thing as the halt, means the same exact thing. But basically what happens is, and if you look at the chart here, you see this guy went from 352 all the way up to 680 within a very short time period. And so what happens is the market makers, the people who control the amount of shares and orders getting filled, so people buying and selling stocks, there's a middleman. There's always a middleman. So that guy, it's probably multiple guys, but those guys have to make sure all the orders match up and get filled at the prices that are available and things like that. So when a stock that doesn't get a lot of volume starts getting a ton of volume like this guy did, see down here volume, and you can check out that forward criteria for what we look for in day trading to find out about volume. But basically volume is the amount of shares sold and bought and sold in a day. So the amount of shares that have been traded in a one-day trading period. So that's volume. And when there's too much volume and there's a lot of buys or a ton of sales coming in, they have to pause the buying and selling of the stock. And that's called the halt. So they have to sit there and figure out how they're going to get all these different orders filled. It usually takes about 5 to 10 minutes. There's several different type of halts. If you want to find out about those different halts, you can just Google stock market halt. There's like a T3 and circuit breaker, and then there's several different ones. One of them you don't want to get caught in, but if you're in a stock and it gets halted, you cannot buy or sell. So if you're already in it, you cannot sell your position out of it. If you're in it on a short, you cannot buy your position back in. So halts are pretty important. Like I said, they kind of act as like a chance for the market makers to be referees and make sure everything's running smoothly and that there isn't any corruption or something not legal on the company's part that you're trading is going down. Like they don't want people to get hoodooed out of their money on these stocks. So that's pretty much all it is. And when you get these halts, usually when it unpauses, you'll have a jump up in price. As you can see here, it probably got halted around here, and then it unhalted and was up to here. So usually when they get halted on the way up with a lot of buying volume, the price is going to jump a good bit. If it gets halted because of a bunch of selling, the price is going to drop a good bit. So to keep things simple, you pretty much either want to try to sell out of a halt. You definitely don't want to buy right after a halt because you don't know which way the stock's going to go. But if you're already in it, you probably want to get out of that position, maybe give it a minute or two out of the halt to see which way it's going to go, because sometimes they can go up higher, but then sometimes they can drop right back down. So you have a little leeway to give it like 30 seconds or a minute to see which way it's going and then get out of that position. So halts are a lot of times can be a good thing, but that's a halt. So let's talk about bid and ask. See over here, this is the level 2, this thing right here, and the level 2 is basically a window to see supply and demand. So your bid is your buy, what the price of the stock is that people are willing to pay for at this time. So like this stock's bid has 3 buyers at 320, at the price of 320. So the bid, the buy, is at 320. That's what they think this stock is worth. This is what they'll buy it for. Okay, so this is your demand. This is your buy. Okay, and your ask is the opposite. Your ask is the sell. This is what people are wanting to sell these stocks for. Okay, so they think that this stock is worth $3.49, and they think it's $3.50, and that's what they're going to sell at. Okay, now right now it's like, well, how do you buy and sell, and how do the stocks move if there's such a big difference? Well, this is after hours. I'm recording this video. Normally it's a lot closer in price, but basically they negotiate and say, well, this guy will say, well, okay, I'll come down to 330, and this guy will say, okay, I'll come up to 330. So they get matched on their orders, and that will pop up in this box called the time and sales. So this is time and sales. Whenever a stock is bought, whenever a deal or a transaction is made, and what time and what the price was. So it would say the time here, the price here that the transaction went through on, and then the size of shares, so the amount of shares. So on your time and sales, and this is kind of a great little lesson, and I'll do a bigger video on this because this is very important. Your level 2 in time and sales is very important. But on your level 2, this says BS and AS. This is bid size and ask size. So this is the amount of shares that this buyer is willing to buy at 320. So on Thinkorswim, you have to add 2 zeros to these numbers. So right now it just looks like, okay, he wants to buy 10 shares. That's nothing. That's not the case. This is actually 1,000 shares. For some reason, it just puts it in this shorthand. Maybe there's a setting to change that. I don't know. I'm not going to look for it right now. But you just have to make a mental note that any of these numbers in the bid size and ask size, there's 2 zeros added. So 2 zeros to this is 1,000. It's 1,000 shares at 320. And this is 600 shares at 320. So this would be 700 shares he's willing to sell, and 1,300 shares he's willing to sell. And so by looking at this, I know this sounds kind of confusing, but what you're doing is looking at the supply and demand. So if you have a ton of buyers over here, so say you've got 10,000 buy here, 10,000 buy here, 5,000 buy here, 12,000 buy here, all at 320, then you're going to know that this is going to hold up as support. And you can watch the when to buy and sell support and resistance video to find out what support and resistance is. But this is going to hold up as support if there's a bunch of buys here, because there's not going to be enough sellers to take that price out. So that price of that stock will be pretty safe there. On the other hand, if there's a bunch of sellers, so there's 10,000 here, 10,000 here, 10,000 here, all at 350, then you're going to know it's going to have a hard time getting past that price of 350, because that's a lot of people selling at that price. So it's probably going to hold the stock up. So this is just your basic window of supply and demand and how you're going to trade your positions when you're in them. So bid is the buy, how many shares that somebody wants to buy at this price. Ask is the sell, how many shares that these sellers want to sell at this price. So that's the bid and the ask. Now let's talk about orders. There's market orders, limit orders, stop loss, limit orders, all kinds of different orders. I use market and sometimes limit. Okay, see right there? You can buy a stop or a limit order if you hold control to issue limit order. Now, the main orders that most traders use are market and limit orders. And here's the difference. Market is going to automatically put you in that stock, but it may not be at the price that you want. So market will guarantee that your order will get filled. You'll either buy the stock that you want or sell the stock that you want. You're guaranteed that, but it will not guarantee the price. So what a limit order does is the opposite. It will guarantee the price. You can put your limit order in, say at $4, and you will get filled at $4 if it gets to $4 and there's a seller there for it. So limit orders guarantee the price, but they don't guarantee that you will get filled on your order. So if you're trying to get in a stock really quickly, it's usually not a good idea to limit in, because you might not get filled and then you just miss out on a big massive move like this from $4 to $6. So that's why I use market versus limit, and that's just the difference between the two and what they are. They're just different types of orders. But market guarantees the order fill, but not the price. Limit guarantees the price, but not the order fill. Okay. So if you're new, there's also watch list, and all a watch list is basically what stocks you're watching in the morning, what stocks you're going to trade. And so you see last is the last price of that stock. So 1 second ago, this was the price of this stock. BLIN was $2.95 1 second ago. It's after hours, so these prices are not going to change right now. But during market, these prices will be changing constantly, as well as the percent change and the volume. The shares are going to stay the same most of the time, unless there's something, which I'll get into, is a stock split. So a stock split or reverse stock split is something companies do to raise money or to make their investors happy. So a reverse stock split is where the company basically, and I'm going to simplify this because it can be very complicated, but to simplify it, say there's 1,000 shares of a company that people can buy, and they decide to do let's say a 5-to-1 reverse stock split. So that means they're going to take 1,000 shares and divide it by 5 and make that into 200 shares. So that 1,000 shares that may have been worth, let's say $5, will now be 200 shares, and it's still worth $5. So the price doesn't change, only the amount of shares that company has to sell to the market. So what you get is a lower float when you get reverse stock splits, which means low float, low supply, high demand, you get big price movements. So reverse stock splits are usually a good thing. A stock split is the total opposite. So say they have 1,000 shares and they want to do a 5-to-1 stock split, then you would times 5 by 1,000. So, something like that. Anyway, it'd be like 5,000 shares that it would turn to. So you get a whole lot more shares, and that is so they can raise money because they have more shares to sell. But normally, this causes the price to go down. So reverse stock splits are good. Stock splits not so good. Okay, so we'll go back over here to the watch list, and symbol. If you're that brand new, symbol is the ticker symbol, which is what you'll use to find stocks list. So IMRN, sorry. And that is just an abbreviation of the company's name. When you're day trading, you really don't even care about the company's name. So you can see IMRN is Imuron Limited. Nobody cares. IMRN is the only thing you care about. Look at BLIN, Bridgeline Digital. Okay, nobody cares. BLIN, that's all we care about. So that's the symbol. Let's watch list. Another basic term, position. You might hear a trader say position. Position is just the amount of shares that you have in a stock right now. So if you buy 100 shares, your position is 100 shares at whatever that price is you bought in. So you bought 100 shares at $1, then right now your position would be 100 shares at $1. So that's all position is. So let's see what else. We got charts. Charts are pretty self-explanatory. These type of charts, though, are candlestick charts. I believe, if I'm not mistaken, and I could be wrong, but I'm pretty sure that a Japanese guy a long time ago, like thousands of years ago or something, I don't know, a long time ago, came up with this type of charting called candlesticks. And to explain what it is, it's a unit of measure. And they're called candlesticks because they look like candlesticks. This one's not the best one to get a basic candlestick. So let's see. All right, so look at this. So now you see this up close. This looks like a candlestick. This is the candle, and this is the wick. So a candlestick, depending on your chart, is going to be a measurement of time and price. So you can see what that stock did. So this day, this was on June 6th. See that down here, 6/6. This stock was in the price range of 702 to 1575. So that's the price that it was at during this day. So this one candlestick represents one day. On your minute chart or 5-minute chart, so you see here, this is your 5-minute chart. Each candle represents 5 minutes. So what that stock did in 5 minutes. If you switch to a 1-minute chart, the candle will be each 1 minute. So how do you look at these and know what's going on? Well, the bottom of the candle on a green candle is where the stock opens at. So here on this day, on 6/11, the stock opened at 752. 752 was the price at the beginning of market open. So at some point during the day, the stock went all the way up here to 1476, and then it had to pull back, making this wick during the day, and it closed at the top of the candle. Now the wick is not the candle, the wick is the wick, so the top of the candle would be right here at 955. So the stock opened at 752 and closed the day at 955. And the full movement with the wick was the move it made throughout the day. So bottom of the candle on a green candle is the open, 955. The top of the green candle is the close. So if you look at this red candle, it's the same thing but reverse. So this stock opened at 1295 at the top of the candle, and it moved all the way up to 1575 at some point, and it came all the way down, and by the end of the day it closed at 698. Okay, so it's the reverse. There's a lot of reverse things in the stock market, and this is one of them. The open on a green candle is at the bottom, the close is at the top. On a red candle, the open is at the top and the bottom is the close. So that's how you read these candles, and there's patterns and stuff that fall in these candles. And patterns are basically different types of patterns, different types of candlesticks together that make a continuous pattern in the market that you can profit off of. So if you constantly see this same type of pattern and it has the same results over and over and over again, then that's going to be predictable. So patterns are basically predictable shapes or symbols or something. There's so many different patterns that people use. I don't use too many. I like to keep things simple. And so I'll do a whole video on patterns, but basically I'm looking for U's and triangles. And let's see if I can find any from today. Well, I don't remember right offhand, so if I took time and looked for them, I could find them. When I do the pattern video, I will show the different patterns. So right here, actually, on this one is a little bit of this is kind of a pattern. As you can see, if I draw a line at the top of those candles, and then at the bottom of these candles, what's that look like? That looks like a triangle. And what happened at this triangle? It had to move up from 781 to 837. So there you go. We're looking for triangles. And you could also say a U shape. I mean, this is more of a triangle, but a U shape would come down like this, and then the bottom would round about like this and then start coming up. So it would be more of a bowl. So that's just what patterns are. You can use lines to draw them, or once you're good enough, you can just look at a chart and oh, that's a pattern. I'm going to jump in here. So let's talk about press releases. A press release is basically what it sounds like. It's a press release. The companies will put out things to get investors excited or to announce that they're going out of business. Press releases can be good or bad. We look for good press releases. So if you look up here, all right, let's go back to BLIN, I think, had a press release. Yeah, maybe. Is that them? No, Bridgeline, heavy trading Wednesday. No, okay. So Bridgeline data to partner with manufacturer to implement B2C e-commerce solution. Shares surged 13%. So that's basically all our press release is. Just telling you what's going on with the company. And we look for good press releases because that makes traders excited. So we look for those massive runs up. On the shorting side, and if you don't know what shorting is, long is when you buy a stock hoping that the price of the stock goes up. So if you're looking at this stock and you bought at 330, you're hoping this price goes up so you can sell it up here to make a profit. Shorting is the opposite. Shorting is you sell shares of a stock right here at this high price and you buy those shares back down here at this low price. And that difference in crash, that difference in price drop is the profits you make. So you're betting against the stock. So when you short, you have to have a margin account, and margin is basically like a continuous loan. Your broker will give you 4-to-1 margin or 6-to-1 margin. So if you have $1,000 with 6-to-1 margin, then you have $6,000 to trade with, but $5,000 of it is on loan from your broker. So when you short, you'd say, okay, when you hit this, all you would do is hit the short button, or on Thinkorswim, you'd hit sell. But this is what happens. You say, hey, broker, hey, TD Ameritrade, I don't think this stock is going to do well. So let me borrow some of the shares that you've got, and I'm going to sell them at $4. And TD Ameritrade says, okay, here you go. Here's 1,000 shares. Sell them at $4. So the price crashes down. Now you have to give their shares back to them. So you buy those shares back from the market around $3 and give TD their shares back. So that dollar difference in price drop would be your profit. Now, on the other hand, if the price of the stock goes up, you still have to buy those shares back. So if it goes up to $5, you've got to buy those shares back at $5, and that difference of price is what you'll owe TD Ameritrade. So shorting is a little more risky than going long, but that's the difference between long and short. Long, you're looking for the price of the stock to go up. Short, you're looking for the price of the stock to go down. All right, so another word you might hear is moving averages. And these are moving averages, these lines here. So this is 200-day moving average, 50-day moving average, 9-day moving average. And a lot of people use different moving averages. I try to use the simplest ones because that's what a lot of people are going to use. And so all a moving average is a line on this chart that says this is the average price this stock has moved in this past amount of time. So the 200-day moving average, this red one, would be the price that this stock moved in the past 200 days in the direction that it's going. So you just use this as support and resistance, and that's in that video as well. So let's see, broker, if you're brand new and you don't have a broker yet, that's going to be just somebody, some website that's a company that's going to be the middleman for you and the market. So like TD Ameritrade is who I use as a broker, and they have this platform that I use, Thinkorswim, which you can use for free. I love this platform, but there's plenty of brokers out there, Lightspeed Trader, Sure Trader, E-Trade. I think Chase has their own now. So there's plenty of brokers to use. I just use Thinkorswim because that's what I'm used to, and I like their trading system because it has everything that I need. So, and like I said, it's free, so that's great. Now it does, with brokers, all brokers have a trade fee. So when you buy a stock, so you buy 1,000 shares, your fee will probably be like $5 for that buy. So $5 of your money will go to the broker for them going and buy the stock for you. And then when you sell, that fee will apply there too. So you have to keep that in mind. But most brokers average around $4 to $5 per buy and per sell. So it's not too bad. I mean, if you make $1,000 on a day trade, then what's $10? You know, you're like, whatever. Now, if you lose a lot, those fees can add up and really kill your account. So you make sure you paper trade before you actually use your real money and invest it.